You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's unpack this. We're doing our deep dive into the global briefing for October 29th, 2025. And really our goal today, our mission, is to kind of give you that shortcut, to understanding what's really driving the markets. We're focusing on three massive forces that are interacting right now. You've got central bank policy expectations, these emerging shifts in global trade, and those geopolitical tensions that are always sort of simmering in the background.
Yeah, it's definitely a day defined by anticipation, policy anticipation mostly. Yeah. You've got the weight of the Federal Open Market Committee, the FOMC decision looming large, plus everyone's trying to read the tea leaves for the Bank of Japan meeting that's happening now. But I think what makes today's briefing really interesting is how that whole policy environment is reacting to these concrete expectations of trade de-escalation between the U.S. and China.
Right. That's the core tension, isn't it? You have this market optimism kind of being fueled by trade talk hope. Yeah. But it's still operating under the shadow of what the Fed might do or say.
Exactly. And what's fascinating here, I think, is how that potential for, let's call it friction reduction in trade, how it's directly hitting market sentiment, particularly in assets sensitive to growth, like industrial commodities. Even with the overall geopolitical risk profile staying pretty high, markets seem to be latching on to these concrete signs of economic engagement right now.
Okay, so let's dive into those immediate drivers first. Let's talk currency currents and these policy pulses dictating the moves today.
Well, the U.S. dollar is kind of the main character here, isn't it? It's trading firmer right ahead of that FOMC decision. And honestly, that's not a huge surprise. Price action globally seems dominated by positioning right now. Traders are basically trying to preemptively price in the expectation that the Fed will stay cautious, data-dependent, maybe lean a bit hawkish, which kind of reinforces the idea of U.S. rates staying resilient compared to slowdowns maybe happening elsewhere.
So if the dollar's firm, where's the pressure point? Where's the weakness? We're seeing it on the European side, right? Sterling still looks weak, mostly because of those lingering UK fiscal worries. And over in Asia, the yen is trading defensively. It had that little bounce yesterday, but now, what exactly are traders looking for from the BOJ meeting that's keeping the yen kind of pinned down?
Yeah, they're not really expecting a massive policy shift, I don't think. It's more about the language. They're hunting for any nuance around how long the ultra-loose policy might last, or any subtle sign that the BOJ is maybe, just maybe, laying the groundwork for normalization down the road. Yeah. Until they get that really concrete signal, the yen's just going to remain vulnerable, especially when global real yields are ticking up.
Okay, but the real volatility standout today isn't London or Tokyo, it seems. It's the Australian dollar, the AUD. That looks like the day's absolute powerhouse. It's trading strongly. The term is bid, right? Because their Q3 inflation numbers came in way hotter than anyone expected.
Oh, absolutely. And that matters hugely for policy expectations. That hotter inflation print significantly slashed the odds of a near-term rate cut by the Reserve Bank of Australia, the RBA. I mean, the market basically went from pricing in a potential cut maybe early 2026 to pushing that expectation much, much further out. And that very quick repricing of RBA policy, that translated directly into that strength we're seeing in the Aussie dollar. It's probably the highest conviction currency move we've seen all week.
Wow. It's a perfect example, isn't it? How just one piece of local data, like inflation, can instantly rewire global FX flows. Meanwhile, keeping things sort of steady in broader Asia FX, we have the People's Bank of China, the PBOC. They keep anchoring expectations by setting a stronger-than-model fix for the USD-CNY pair. For listeners maybe not deep in the FX weeds, what does that technical move actually signal for regional stability?
Well, it's an explicit policy statement, really. Stronger-than-model fix basically means the PBOC sets the yuan central trading point higher, stronger for the yuan than what market models alone might suggest. It's effectively leaning against bearish sentiment. So it signals Beijing really wants to maintain currency stability. And that's vital for confidence across the region, particularly when you've got these high-stakes leader-level talks coming up.
Okay, let's pivot then. How is this whole policy and FX landscape feeding into commodities? Let's start with the big one, the ultimate gauge of risk sentiment and real rates. Gold. Gold's back above that significant USD 4,000 an ounce level ahead of the Fed.
Yeah, that $4,000 mark is really reinforcing itself as a key psychological level, a magnet. If you see gold trading comfortably above that benchmark before a potentially hawkish Fed meeting, well, it tells you the market probably believes two things. First, that global geopolitical risk isn't going away anytime soon, it's persistent. And second, that whatever the Fed does today, maybe the longer-term trend of declining real interest rates globally is still intact. It seems traders are viewing $4,000 more as a structural floor now, not just some temporary peak.
That sounds like some real structural confidence building there. But the trade that seems even higher conviction, maybe, industrial metals. Copper, the classic bellwether for global growth, it's probing record territory again. And the briefing explicitly links this to two things: an improved macro risk tone, and crucially those little signs, those incremental signs of U.S.-China trade de-escalation.
Oh, the link is absolutely crucial. You can't overstate it. When copper hits record highs like this, the market isn't just pricing in like a temporary ceasefire. It's starting to price in more structural, maybe long-term trade confidence and the future industrial demand that comes with it. Copper really acts as a proxy for the whole global economic engine. Its strength suggests investors are betting that maybe the geopolitical noise of the past few months might actually give way to renewed, steadier physical trade flows.
Okay, but if copper is all optimism, then oil seems to be giving us a dose of reality. It was chopping lower, even though some private inventory data looked kind of bullish. Why isn't oil fully joining this commodity rally that seems driven by trade optimism?
Right, because oil has this tougher balancing act, doesn't it? It's caught between two competing forces that maybe copper doesn't face quite so directly. You've got the macro headwinds possibly hitting demand on one side, and then on the other, you've got fresh supply headlines and geopolitical stuff directly impacting production. So the fact that oil stabilized but lower suggests traders are probably weighing those macro and supply risks more heavily than just the improved trade sentiment. It kind of shows us that trade detente, well, it's only half the story. We still have to deal with that persistent risk map out there.
That distinction is a perfect lead-in to what seems like the core driver for the week, this idea of trade detente and supply chain realignment. Tariffs and trade talks seem to be setting the tone for the next few sessions, maybe even overshadowing the central bank decisions in terms of where markets head next.
Yeah, the main focus is definitely that friction reduction between Washington and Beijing, and it really centers on tariffs right now. Apparently, they're preparing discussions to potentially have those 20% levies, the ones specifically linked to fentanyl.
Can you give us a bit more context there? Because these aren't just standard trade tariffs, are they?
No, not at all. These were put in place for very specific political and social reasons, right? They were designed to target certain Chinese chemical exports tied to the fentanyl crisis in the U.S. So because the issue itself is so politically charged, the fact that both sides are even willing to discuss having that 20% levy, that's a major signal. It suggests a potential reduction in political risk, but it's all contingent, of course, on how the leader-level talks actually go. It signals an intent to maybe de-escalate, even on non-economic fronts.
And we've already seen some tangible goodwill gestures pointing towards maybe an agricultural détente. China's state buyer, COFCO, bought 3 cargoes of U.S. soybeans, apparently totaling around 180,000 tons.
Exactly. That's the kind of concrete, measurable action that markets love to see. It's a direct deliverable, showing intent before the main talks. And beyond that, officials also sort of telegraphed an intention to look at reducing reciprocal port fees. Now, these fees themselves might be minor in the grand scheme of shipping costs, but reducing friction on the logistics side, that's a symbolic step. It's like oiling the gears of global trade again.
Okay, shifting away from the U.S.-China axis for a moment, we're seeing other global trade updates that suggest this major realignment is happening everywhere. Like the U.S. signaling it's close to concluding a trade package with South Korea, even though there are still bigger investment questions lingering between Seoul and Washington.
Right. But the really high-stakes game, maybe, is playing out closer to home in the Western Hemisphere, and it's all about supply chain security. The U.S. Senate moved to get rid of some old legacy tariffs on Brazil. And almost at the same time, U.S. envoys were down there sounding out Brazilian mining companies, specifically about rare earths.
Ah, okay. That sounds like a classic strategic play, doesn't it? The U.S. removes some old, politically maybe annoying trade barriers in exchange for potentially getting cooperation on securing future critical minerals.
Precisely. It just highlights this fierce global scramble. to secure supply chains for critical minerals, especially rare earths. I mean, these are essential for everything from defense tech to green energy. The whole geopolitical risk landscape means every major player is desperately trying to diversify its sources and reduce reliance on potentially adversarial suppliers.
And speaking of reliance and security, that brings us back to energy policy constraints, particularly in Asia.
Yeah, if we try to connect this back to the bigger picture, Japan apparently flagged how practically difficult it would be for them to actually ban Russian LNG imports. Now, this is really critical. Despite all the strong political pressure from the West, Japan is basically acknowledging that energy security constraints, the simple need to keep the lights on and keep industry running those constraints, are actively shaping Asia's future policy choices. It shows how economic reality can often override other political or strategic goals. Some supply chains are just too critical, too embedded to sever quickly or easily.
So, okay, we've got this rising trade optimism, high commodity prices reflecting that. But that optimism clearly has to navigate the persistent noise coming from the global risk map. Which brings us to segment 3, reminding us that while things might be tense, the geopolitical environment is still, for now, largely contained.
Exactly.
Yeah.
It's tense, but contained. That's a good way to put it. Starting in the Middle East, Israeli forces reported some renewed enforcement actions related to the Gaza ceasefire framework. This was after strikes at Gaza City. Officials there warned about potential additional responses if violations continue. So that situation obviously remains volatile. It needs constant watching because it has direct implications for regional energy supply, shipping, all of that.
And moving over to Northeast Asia, we saw another spike in regional risk. North Korea fired a missile described as part of its nuclear forces. The fact that Pyongyang seems to be deepening its strategic coordination with Moscow, well, that just keeps regional tensions dialed up significantly. This feeds directly into that severe security environment U.S. officials keep talking about, right?
It absolutely does.
Yeah.
Yet, interestingly, we also see some efforts towards stabilization, even on really contentious borders. China and India held high-level talks about managing the western part of their shared Himalayan frontier. Now, the key takeaway wasn't some breakthrough resolution, obviously not, but it's a commitment from both sides to keep communication lines open, using those established military and diplomatic channels. Just having dialogue, even over disputed territory, can act as a kind of brake on potential escalation.
And linking that back to the alliance structure in the region, U.S. officials reiterated that the security environment around Japan is severe. They highlighted the absolute necessity of alliance deterrence. So this is that complex balancing act we're seeing play out, isn't it? You have leaders pursuing high-level trade diplomacy with Beijing on one track, while simultaneously reinforcing military readiness and alliances on another.
Which I think raises a really important question for you, the listener. Now that we've sort of unpacked this global briefing, what are the key indicators you should be watching? Well, the immediate focus has to shift very heavily towards the actual policy outcomes. What do the Federal Reserve and the Bank of Canada actually do and say?
Right. And domestically, for the U.S.-China piece, we need to see those concrete deliverables from the Trump-Xi meeting. It can't just be general good vibes. We need specifics on tariffs, maybe new agricultural purchase commitments, those port fees we mentioned. Those are the things that will either validate or undermine the optimism that's currently priced into assets like copper.
And of course, we have to keep watching for any fresh geopolitical sparks. Anything in the Middle East or Northeast Asia that could suddenly alter the energy and metals balance as we head towards month end. A new escalation somewhere could instantly unravel this trade-driven rally we've been talking about.
So just to give you a final synthesis, a quick snapshot. In FX, it's led by a firm U.S. dollar and that strong inflation-fueled Aussie dollar. Gold seems stable, structurally supported above $4,000 an ounce, and copper remains buoyant, really aggressively supported by these hopes of a fundamental trade de-escalation.
Yeah, the market is clearly placing its bets, for now at least, that the political will for trade stability might just manage to outweigh the ongoing geopolitical volatility.
So what does this all mean for you thinking about the bigger picture? We talked about China buying those 180,000 tons of U.S. soybeans as a goodwill gesture. But consider this. How does that specific volume, 180,000 tons, become almost a measure of geopolitical trust? The question isn't just the dollar value of those soybeans. It's how the market prices the fragility of that trust. If trade optimism is driving copper to record highs today, how quickly could those 180,000 tons turn back into just a worthless political token if the talks suddenly break down? We'll leave you to chew on that, how global trust gets quantified sometimes in tons of agricultural futures.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.